Good morning. Welcome to Stock Market Today. It's Tuesday, January 19th, 2021. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So I hope everybody had a great long weekend. Let's dive right back into it. First, a quick recap. U.S. equities finished lower on Friday, with all major indices except the Russell 2000 down for the week. REITs, utilities, and healthcare outperformed on the day, while energy and financials lagged the broader tape. Treasuries were stronger across the curve. The dollar was stronger against the euro and sterling, but little changed on the yen cross. Gold finished down 1.2%. WTI crude settled down 2.3% to close out the week. Now, as we get to the desk this morning, S&P futures are up 70 basis points coming out of the long holiday weekend. Pro-cyclical areas of the market extended their recent outperformance on the week last week. Asian markets were mostly higher overnight, with Hong Kong up 2.5% plus. China did end lower on the day. European markets are mostly higher. Treasuries are weaker across the curve. The dollar is stronger against the yen, weaker on the euro. Gold is up 70 basis points. Crude oil is up 20 basis points to get us started on what should be a busy week, as we are in the heart of earnings season. Janet Yellen's confirmation hearing scheduled to take place today, and obviously a lot of moving parts as it relates to the vaccine. So let's kind of distill all that down, and you basically, it's a lot of the same from a trend perspective. New week, but the trends remain the same. S&P 500 continues to have support at 360, then 340 below that. As we've been saying for weeks now, above 340, we think you continue to play for upside to 413. Qs gave a little bit back in the tail end of the week last week. 260 is key. 300 is important in the near term. So again, not much has changed there. Remember last week we bumped near-term support up to 190 for IWM. Key areas in the 160 to 170 range. So again, as I've said repeatedly, I'd love to change my tune one way or the other, but the data and the trends just don't warrant a change of tune. I think where the action is happening is under the surface of the market, and we'll explore some of that today, as it is Tuesday, and we look at our relative work at the sector level. We talk about relative trends across themes, market caps, sectors, even outside of the U.S. And different asset classes. We do that all the time. Tuesdays tend to focus on our sector work, so we'll keep it there today. But again, as always, just kind of looking at the averages, I think you need to take it a step further, because you're going to find your opportunities in the relative strength, the relative weakness, the shifts in those relative trends. That is, to me, where the opportunities lie, and that is where we will continue to look for and highlight shifts in the trend, as well as the opportunities that we think are most compelling. Now, our market in a minute. What are we writing about today in the note as we get back from the long holiday weekend? Well, stocks paused in their uptrend after reaching overbought levels. One of the things that I was highlighting in my notes last week is that our short-term overbought oversold indicator for the major indices, save for the Qs, all the key leading areas were overbought. I'm wondering if Treasury investors are shifting to dividend stocks for yield. We'll take a look at what I'm talking about a little bit later on in the show. Comm services. Remember, comm services came under a lot of pressure last week, especially earlier in the week with Twitter and Facebook down after their decisions to deplatform the president. Well, they fall into the next relative support level. We'll take a look at what that looks like. Sticking with our theme of running a screen, we're going to run for classic bulls in earnings season. Going to touch on that a little bit more in just a moment. Futures, as I said, point to a higher open here today. Let's take a look at the power bars now for the major indices. The Dow lost 58 basis points on Friday, 6-2 bulls to bears there, though. S&P down 0.75%, NASDAQ down a like amount. Those ratios remain bullish, 131 to 58, 22 to 15, respectively. Small caps, an underperformer on the day, rare bout of underperformance recently. Down 1.5%, 844 to 117, bulls to bears. Bonds down, uptick, sending yields lower. REITs were your best sector on the day. It was actually your defensive groups that were solid on the day Friday. REITs and Utes towards the top of the list for Friday. However, 2 to 8 bulls to bears on the power bar ratio, still a lagging group from a relative trend perspective. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain strongly bullish. Let's touch on that screen now. Now we're getting into the heart of earnings season. The big banks kicked it off last week on Friday, and quite frankly, not well received as JP Morgan, Wells Fargo, and Citigroup earnings reports were somewhat of sell the news events. But we are getting into the heart of earnings season. I wanted to drill down on something that I think is interesting. Now, we have a screen that we run called Classic Bulls. A Classic Bull at Chaikin Analytics is a stock with a very bullish or bullish rating that's above its long-term trend line, with 6-month highs in persistency for both money flow and relative strength. Now, considering it's earnings season, I wanted to drill this down a little bit further by factoring in some of the earnings factors, two of which that I think are compelling. Earnings consistency, i.e. how good is the company at meeting or beating expectations, and then what is their propensity for earnings surprises. So I set both of those factors, those are 2 of the 20 factors within our model. I set both of those factors at bullish, and we get 33 stocks that represent an interesting kind of cross section of the Russell 3000 universe. So obviously the home builders have been in focus. You see names like Beazer Homes there. On the industrial side, Quanta, Perkin-Elmer has been a name that we've been highlighting a lot lately. Deckers and Dick's are 2 names that have highlighted over the past few months. Intuit is another name that I've highlighted. Gaming stocks, obviously, always kind of interest. I happened to write our note over the weekend where I highlighted Activision. You can see that Take-Two passed this screen today. So kind of an interesting dynamic here. ADM is a play on that ag commodity theme that I've been talking about for a while. So kind of a really interesting mix of names here. Feel free to take a screenshot. These names can be monitored as we go through earnings season. Should they present some opportunities here in the near term that fit with your style? So I wanted to highlight that. I think it's an interesting screen that we're calling out here on the show today, as well as in my note for clients. Let's hit our sector tracker now. Movement of the major sectors over the last 5 days. Despite giving back about 4% on Friday, energy is still at the top of the list. REITs and utilities step up. A little bit of a counter trend move here in the near term. Fins, even with the banks under pressure on Friday, the fins were still positive over the past 5 days of trading. Healthcare, industrials, materials, and discretionary are middle of the road and lower. Last week was a fairly choppy week. Listen, we were down on the week, so Staples, Tech, and Comms at the bottom of the list. We know what's happening with Comms. We know Tech is under pressure as well. We'll take a look at Tech a little bit later on a relative basis, but I do think it's important to highlight the fact that it seems to be large cap tech that is bearing the brunt of the negative side of the rotation, if you will. Now, our industry in focus today is kind of interesting to me. It's pharma services. Past 6 months, a slight outperformer relative to S&P 500, leading by about 3.5%. However, it does have a weak power bar ratio, 8 bulls for 11 bears. It's ranked number 19 of 21 subsectors that we track. Axum, AXSM, Zogenix, ZGNX, and Reata, RETA, all with very bearish ratings. Those 3 are in this group of 11 here. But the fund itself looks a little bit more constructive. Now, it does have a neutral rating for the ETF here at Chaikin Analytics. We touched on the ratio 8 to 11 bulls to bears, but a strong trend. I mean, there's no 2 ways about it. And what's interesting to me is that after being a laggard for many months, has more recently been an outperformer. Money flow shifting to the bullish side. We're moving towards an oversold condition. So I don't think you can just dismiss the group. I think that you can drill down on the group and look for potential opportunities. Now, we said that there were 8 stocks with bullish ratings here in our model at Chaikin Analytics that are holdings of XPH, and I've highlighted those here. You can see them on the screen. Feel free to dive in on those names here in the days ahead. See if there are any potential opportunities. Let's hit what's trending now Friday's S&P 500 movers and shakers are gainers and losers. Not a ton of company-specific news on the winner's side of the board. NI up nearly 5%. No news there. Abiomed, ABMD. There was some positive news earlier in the week. Maybe that's translated through to the end of the week, up 3.5%. Akamai, nothing company-specific to drive the stock higher there. CNP did catch an upgrade from Goldman Sachs. That stock higher by nearly 3%. LNT, no company-specific news there to send the stock higher by 2.87% on the day. Now, the loser side of the board obviously does have a little bit of news. Wells Fargo, their earnings announcement, as I said, was a sell the news event. Also some trepidation, if you will, about their net interest outlook for 2021. That stock lower by 7.8%. Oxy's been a monster of late. So maybe just giving some back, down 7.6%. Also a little bit of a headwind from the energy sector on the day, which has been really strong of late. Citi, again, they reported earnings. Investors sold the news there. Remember last week we were talking about how the banks were overbought heading into earnings season. I highlighted that chart of KBE. So the initial batch of earnings reports met with a bit of a sell the news type mentality. Citi did have some revenue comments in the year ahead that maybe gave investors some pause as well. CXO, Conoco COP completing their deal for Concho coming out of the S&P 500. So some moving parts there, down 6% on the day. APA down nearly 6% on the day. Nothing company specific to drive the trading there. Maybe just getting caught up in the near term, or the one day, if you will, weakness in the energy complex. Let's dive in now on the charts. Right, Tuesday, relative strength day. We look at the sectors. We try to get a sense for where money's flowing. Now, last week in our note, we highlighted the breakdown in comm services, and that continued throughout the week, bringing the relative ratio of XLC to SPY back down to this congestion area that was in place for much of 2019 and the early part of 2020. So if comm services is going to stage a rebound, you're going to want to see it stage its rebound from here. Now, the RSI of the ratio did move into oversold conditions with this move lower. And it's interesting that it's the first time that we really became oversold in more than 2 years. So does this mark a trend shift? I don't know. Time will tell. And it's really we'll get our answers by studying the nature of this rebound here in the near term. Is it kind of a tepid rebound that kind of gets us back up towards this consolidation zone and the 200-day moving average? If so, and RSI can't get much above 50, 60, I think you have to say to yourself, this relative trend here is shifting to the downside. Time will tell. I wish I had a better answer for you. I just don't, and I'm not going to make it up. It's certainly on my radar screen because there are a lot of important names within this sector for their kind of impact on the market. So obviously we want to be paying attention to it, but it's hard to get a clear answer now other than say we are testing support. But it's not exactly smooth sailing up ahead. There's this huge congestion zone to the upside. So we want to be mindful of that. Tech is another group that's obviously on everybody's radar screen. XLK relative to SPY, we've been highlighting the relative stalling and then breakdown. Now we're between the moving averages, the 200-day and the 50-day, kind of getting here to downtrend support. 200-day moving average is important. Now, what's interesting and what gives me some positive thoughts is the fact that these pullbacks have not been able to produce oversold conditions on a relative basis. So perhaps it's just a matter of the group got extended. If you go back and recall back what I was saying at the end of August, that tech and the Qs that were extended from the 200-day moving average. So maybe this is just a function of working off that extended position. Now that the 200-day moving average has had time to catch up, perhaps the stage is set. We'll have to watch and see how things play out. Now, on an absolute basis, tech is trying to break out, but just not getting there yet, as you can see at the bottom of the screen. And finally, we've talked a lot recently about the pressure on treasuries, and it has me wondering, where is that money flowing? Perhaps it's flowing to high dividend stocks. Going a little further out on the risk spectrum, SPYD above those June highs, solid RSI, and a shift in the scooter kind of looks interesting to me here in the near term. That's going to wrap us up on a Tuesday. Take us for a test drive. I am back with you tomorrow.